Capital gains tax is one of the most misunderstood parts of the Canadian tax system. Many people hear the term but aren't sure when it applies, how much they owe, or why only part of the gain is taxed. In this video, we'll explain what capital gains tax is, how it works in Canada, and how different accounts change the tax you pay. Let's start with the basics. A capital gain happens when you sell something for more than you paid for it. This could be an investment like a stock or ETF, a rental property, or other assets that increase in value over time. This could be an investment like a stock or ETF, a rental property, or other assets that increase in value over time. The gain is the difference between what you paid and what you sold it for. If you bought something for $10,000 and later sold it for $15,000, your capital gain is $5,000. Here's the key rule in Canada: only part of a capital gain is taxable. Currently, 50% of your capital gain is included in your taxable income. So using that same example, if you made a $5,000 capital gain, only $2,500 is added to your income for tax purposes. The other half is not taxed. This is why people say capital gains are tax-advantaged compared to regular income. But that doesn't mean capital gains are tax-free. How much tax you actually pay depends on your marginal tax rate. The taxable portion of the gain is added to your other income for the year and taxed accordingly. Let's walk through a simple scenario. Imagine you earn $60,000 a year from your job. You sell an investment and realize a capital gain of $10,000. Only half of that gain, or $5,000, is added to your income. Your taxable income becomes $65,000, and the tax you owe depends on the brackets you fall into. Now let's talk about where capital gains matter most, the type of account you're using. In Canada, capital gains are treated very differently depending on whether the investment is held in a TFSA, an RRSP, or a taxable account. Inside a TFSA, capital gains are completely tax-free. If you buy an investment in a TFSA, it grows, and you sell it at a profit, you pay no capital gains tax at all. This makes the TFSA extremely powerful for long-term growth. Inside an RRSP, capital gains are not taxed when they occur, but withdrawals are fully taxable as regular income later. That means capital gains don't get special treatment when the money comes out of an RRSP. Inside an RRSP, capital gains are not taxed when they occur, but withdrawals are fully taxable as regular income later. The tax benefit comes from the deduction when you contribute and the possibility of being in a lower tax bracket when you withdraw. In a non-registered, or taxable, account, capital gains tax applies exactly as we discussed earlier. 50% of the gain is taxable, and the amount of tax depends on your income level. Let's compare these accounts with a realistic example. Suppose you invest $20,000 and it grows to $30,000. That's a $10,000 capital gain. In a TFSA, you keep the full $10,000. In an RRSP, there's no immediate tax, but when you withdraw the money later, the full withdrawal is taxed as income. In a taxable account, $5,000 of that gain is taxable in the year you sell. This is why account choice matters so much. Another common misconception is that capital gains tax only applies to wealthy investors. In reality, many everyday Canadians trigger capital gains when they sell investments, rental properties, or even small portfolios they've built over time. Capital losses are also part of the picture. If you sell an investment for less than you paid for it, you may have a capital loss. Capital losses can be used to offset capital gains, reducing the tax you owe. Capital losses can be used to offset capital gains, reducing the tax you owe. This can be useful for tax planning, especially in years where you realize multiple gains. The key takeaway is this: capital gains tax isn't something to fear, but it is something to understand. Knowing how it works helps you make better decisions about when to sell, what accounts to use, and how taxes fit into your overall plan. This content is for educational purposes only and not financial or tax advice. If you found this helpful, consider subscribing for more clear explanations of Canadian personal finance topics.